Sorry for keeping you guys waiting. I've been trying to log on. Sorry, please. All right. We need to round up on the topic we started like 3 weeks on sources of finance. Tonight we shall round up on this topic, and if time permits, we shall move to the next topic. We shall be rounding up finance success tonight by looking at sources of debt finance. You may recall when we started this topic, sources of finance, we explained that majorly finance sources can be categorized into two. At the start of this topic, we explained that finance sources can be categorized into two. One is equity finance, and the two is debt finance. So far, we have explained equity financing. Tonight, we shall focus on debt financing. What is debt finance? What are the different of various sources of debt finance? What are the benefits of financing business with debt? What are the risks involved when you finance your business with debt? We shall be looking at this tonight. What is debt finance? Debt finance refers to finance contributed to the business that is not coming from the owner of the business. Debt finance. Debt finance refers to all forms of borrowing to the business. Debt finance refers to all forms of borrowing. A company can decide to borrow to finance its business. Once you obtain loan, then you are utilizing debt finance. You can finance your business with equity. Money contributed to the business by the owners of the business. Alternatively, you can finance your business with debt finance by borrowing. Now, debt finance can be divided into three or two. We have short-term debt financing. That is division one. You can have debt finance into three categories. We have short-term debt finance. We have medium-term debt finance. And we have long-term debt finance. the categorization into short-term, medium-term, or long-term is a function of maturity period. The categorization of debt finance into short-term debt finance, medium-term debt finance, or long-term debt finance is a function of the duration of the loan, the maturity of the loan. Whether short-term debt finance, whether medium-term debt finance, whether long-term debt finance, these are all forms of borrowing. Now we start with short-term debt finance. Debt finance for a short repayment period, for a short maturity period. Under short-term debt finance, you can have bank overdraft. So what is bank overdraft? Will ICAN ask you to define bank overdraft? Definitely, ICAN will not ask us directly to define bank overdraft. However, you may be required to explain impliedly what is overdraft or what are the characteristics of bank overdraft. Let's explain this. Bank overdraft. Company can decide to arrange a bank overdraft to finance its need for cash. A company can decide to arrange bank overdraft to finance its need for cash. Overdraft facility is negotiated with a bank, which allow a company to withdraw an amount over its current available balance. Overdraft facility allows a customer to withdraw its account over and above the current available balance. From the viewpoint of the bank, overdraft facility should be used as follows. Please listen to this. Overdraft facility should be used to finance short-term operational needs. Overdraft facility should be used to finance short-term cash deficit activities. Please note that point. Overdraft is used to finance short-term cash deficit from activities. You utilize your overdraft to finance short-term cash, short-term projects. Point number 2. The overdraft balance is expected to fluctuate regularly between the deficit position and the surplus position. In other words, you are not expected to keep the overdraft balance at a permanent position. The overdraft balance is expected to fluctuate. There must be movement in that account. The account should fluctuate between surplus and deficit. Meaning that if you take an overdraft today and you are using the overdraft to finance operational activities, you will be expected to make sales daily. And the sales proceeds should be paid into the account daily to reduce the overdraft, to reduce the overdraft balance. You are not expected to place the overdraft balance at a permanent position. Point number 3 is that we have mentioned this. Overdraft facility is a temporary network glitch. Okay, let's continue. We are trying to explain overdraft. That is the characteristic of overdraft as a source of finance. An overdraft facility is for operational requirements. Please, you cannot use overdraft to finance long-term projects or assets. Lastly, the bank normally has the right to call in an overdraft at any time. Overdraft can be recalled at any time, and the customer will be expected to repay the amount of overdraft immediately. There is no specific repayment time for overdraft. If the bank is not comfortable with the way the customer is operating his overdraft account, has the customer to pay up the amount overdrawn, and the customer is expected to regularize the accounts within the time stipulated by the bank. Now you can appreciate that if you look at this very well, there's a risk involved when you finance your business with overdraft. You know, if you are discussing, you'll be able to appreciate that, look, I cannot finance a long-term project with bank overdraft, because bank overdraft is meant for operational activities, not long-term assets.
Hello, sir.
Yes, please.
Is there a
yes, please.
Hello, can you hear me, sir? Hello?
Please go ahead.
Is there a rate, as in
an
amount? Is there an amount that the maximum amount? Is there any agreement for the maximum amount you can withdraw?
Is that your question?
Yes, sir.
All right. First is, this is individual bank's decision. Giving a customer overdraft is the decision of the bank, and the amount The bank can decide to give customer A larger amount. The bank can decide to give customer B a smaller amount. And the bank can deny customer C. It is a finance that is very risky. You can apply to bank that you want to take overdraft. Of course, bank will look at the operation of your account. Now, bank will now look at the risk the bank is willing to accept. Of course, bank will also ask you, if you are taking this overdraft, what do you intend to do now? You cannot tell bank that you want to finance the purchase of an equipment with overdraft, because that equipment is for long-term projects. Bank will expect you that you should use the overdraft for operational activities. For example, you are into bakery business. You are into bakery business and you require raw material, flour, for example, on a daily basis. The bank can grant you overdraft to purchase your raw material, flour. This raw material is required for operational needs. This raw material will be used to bake your bread or your cake. When you are baking your bread, you make sales. As you are making sales, you are getting sales proceed. The sales proceed, you are expected to pay the sales proceed into the account. That sales proceed will be used to reduce the amount of overdraft. That means on a daily basis, as you are taking the overdraft, you produce your bread, you bake your cake, you make sales on a daily basis. You are getting sales proceed. The proceed will be paid into the bank account. That means you are using that overdraft for operational activity. That is the expectation of the bank. So there is no specific amount. It is a function of the individual banks and the extent to which the bank is comfortable with you. Bank may give customer A 100 million overdraft, depending on your volume of operational needs and the extent to which the bank believe the customer based on your based on your cash flow projection, because no bank will give you loan without a cash flow projection. If I'm giving you this overdraft, what is your daily sales? How much do you generate daily on sales? Give us a cash projection. Bank must have a reason to provide that overdraft. Is that clear, please? So the risk here is, if bank discover that the company is not managing its finance very well, particularly if the overdraft balance is kept at a permanent position. You have taken an overdraft of 50 million, and which is meant to be for operational need. Day 1, day 2, day 3, for 1 month, you are not making any sales. To reduce the amount overdrawn, definitely bank will ask questions. Bank wants to know, are you not making sales daily? Or you are making sales, you are diverting the cash to another bank. Bank will ask questions. You are not expected, at a point where bank discover that the overdraft facility is not well managed, bank reserve the right to recall an overdraft facility, and the customer is expected to repay the amount. So please note, overdraft is a risky source of financing. Overdraft is a risky source of financing. Number two, under short-term debt finance, we have short-term bank loan. You can approach a bank. A customer can approach a bank to arrange a short-term bank loan for a specific business purpose. Unlike overdraft facility, a bank loan is for a specific period of time. In other words, unlike overdraft, there is no specific repayment date. But for bank loan, a short-term bank loan, there's going to be a specific repayment period. And there's going to be a repayment schedule. So the bottom line is, company can adopt short-term bank loan to finance their business. Number three, trade credits. A company can arrange or negotiate a favorable trade credit from its suppliers. You can obtain a credit terms from your suppliers. What is trade credit? You can decide to buy material or your products from the supplier on credit, and you are going to pay back at the agreed future period. Trade credit from suppliers usually come at no cost. It's an attractive method of financing on a short-term basis. Like the example we gave, imagine you are running a bakery business and your major raw material is flour. You can approach flour mills and obtain flour on credit. You can get this flour on credit. You go into the production of your product. When you make sales, you repay as agreed. Flour mills will be happy to give you this credit because they have made production. By taking the flour, you are helping their sales. Once they can see that trust and dedication to your business, since you produce bread every day and you are making sales every day, there's assurance that when you collect flour of 20 million naira today, you can repay next week, collect another flour again. This is trade credit. Company can adopt trade credit as a means of financing, and this will fall under short-term debt finance.
Hello, sir.
Debt. Yes, please.
Sir, please, it's just an observation. Last week, you taught us all this. We even did examples up to one point. So I don't know if this is a recap of the class or you're teaching it all over again.
Just one. Do I deliver a lecture on this?
Yes, sir.
No, sir, no.
No, I think you
I've not
deliver
de-
on long time, sir, not short time last week.
I didn't deliver, please. I didn't deliver any lecture on debt. All the lecture I've delivered so far, I've delivered lecture on equity financing. What happened last week? Maybe what happened is that when we were solving question, we had a question that said we should look at rights issue and convertible debt. I have not taken lecture on debt financing. I
So
didn't explain
I
trade
think maybe
credits.
she take a CR on a debenture.
I'm talking of my SFM class. I have a track
That's
of what
all.
I have treated. When we're solving questions, I've solved 3 questions on source of finance for you. At some point, the examiner said we should explain, we should write a report. We should write a report on rights issue and convertible loan stock. So I'm pretty sure I have not explained trade credit. I didn't explain bank overdraft. So can somebody also confirm this? I didn't do that lecture. So I'm not doing a recap. No, sir. You're always in class. Have I taken this lecture before?
No, the short term. You didn't cover the short term. You didn't cover
I didn't even cover long
short
term,
term, the
sir.
what you're talking about now.
I didn't even talk about long term. I only okay, no problem. So that we don't take the class too much. All right, let me quickly round up this. Debt factoring. What is debt factoring? A factor, let me start with a factor, or a debt factor is a commission agent or a paid agent who is commissioned to collect trade receivables on behalf of its clients. I'll take that again. A debt factor is a paid agent who is authorized to collect trade receivables on behalf of his clients. Company can use debt factor to collect their trade receivables. Now, one of the services rendered by a factor is to provide finance upfront. A factor can provide finance upfront or immediately, up to 70% or 80% of the value of trade receivables the factor has undertaken to collect. Let me explain that briefly. First, we understand trade receivables, where a company makes sales on credits and the customer is expected to pay back at a future date. This will be represented as part of our trade receivables. Now, the company in question can decide to contract the collection of these trade receivables to a factor, an agent who is going to collect the amount of trade receivables when it is due. Now, this factor can provide money immediately to the company. And later, when he realizes the trade receivables from the client, he will now do deduction. What we are saying is, let me take Dangote. Let's assume Dangote had made a sales. Dangote made a sales that was 100 million naira to a customer. And the customer is meant to pay back in 6 months. In the book of Dangote, this will be documented as trade receivables to be collected 6 months. Now, Dangote can transfer collection to a factor. Dangote can decide to transfer the responsibility of collecting the trade receivables to a factor. One of the services rendered by factor is that they can provide the amount for you upfront. In this case, the factor can provide up to 80% of the amount immediately to the company. By providing this amount to the company immediately, that means the company is accessing finance. In other words, company can adopt debt factoring as a source of financing. Lastly, under short-term debt, we have.
Hello, sir. Sorry to ask. What about if the factor was unable to collect the debt up to that percentage?
Okay. First is the arrangement between the factor and his client is a legal arrangement and it involves a lot. But what we are treating tonight is you can use debt factor to source finance. What we are treating tonight is company can adopt debt factoring as a means of sourcing finance. It's a very wide topic on its own. When you get to working capital management, it involves a lot. You can have what we call debt factor without recourse and with recourse. You can have without recourse and with recourse, and it's a legal arrangement. If you are doing without recourse, that means that if the factor should provide money upfront for the company, and it cannot collect the money from the debtor, he can't collect the money from the debtor. That means he bears the loss. So it will depend on the legal agreements or the legal arrangement between the factor and the company. So, but the bottom line, what I'm trying to stress here is, for this topic, what we want to pick out is a company can use debt factoring as a means of sourcing finance, and this will fall under debt financing. This will fall under short-term debt financing. Is that clear, please? Operating lease. What is lease? In some cases, operating lease might be used as an alternative to obtaining short-term debt finance. Operating leases is similar to rental agreement for the use of non-current assets. Operating lease is simply a rental agreement for the use of non-current assets, usually for a short period of time. You can obtain an asset on operating lease. You can obtain the use of an asset on operating lease. The company will only pay rental agreements annually without purchasing the asset. Now the question is, how does this translate to source of finance? How does operating lease translate to finance success? Companies that obtain the use of non-current assets with operating lease agreements avoid the need to purchase the assets and to finance these purchases with capital. If you obtain an asset with operating lease, you only pay rent. Therefore, you avoid the need to buy the asset outrightly. And to obtain finance to purchase this asset. For example, an asset that worth 100 million, an equipment that worth 100 million. If you are to buy this equipment, we either approach a bank to obtain loan, or we source finance from alternative sources. One of the alternatives is to go into operating lease. We can obtain these assets on lease, on leasing. We only rent the asset. We are not paying, we are not purchasing the asset. By leasing the asset, we are able to obtain the asset without going to borrow money, without the need to go and be sourcing for finance. That means technically, we have used operating lease to obtain the use of an asset. And we are, in other words, we have been able to obtain financing. All right, all these five, any question, please? These five will fall under short-term debt finance. Like I explained, debt finance collectively refers to other people's money in financing business activities. The debt finance could be long-term, medium-term, or short-term. Our long-term debt finance. For your long-term debt finance, you can have issuing of bond. What is bond? Bonds are long-term debt instruments that can be used to obtain borrowings. Bonds are long-term debt instruments that can be used to obtain financing. In some instances, your bond can also be called debentures or loan stock. In some cases, you can refer to your bond as loan stock. The bottom line is you can use this instrument to obtain borrowing at a longer term period. Medium term debt finance. Like I explained, the issue of long term, medium term, short term is a function of the maturity period. Medium term debt finance is usually in form of bank loan. Medium term debt finance is usually in the form of bank loans. However, at times, company might issue bond with a short term with a few year maturity. This is called, please note, medium dated bond are called loan notes. Please note this time, medium dated bond, that is bond with a medium time maturity, 5 years, 6 years. These are called loan notes. They all perform the same function. They are debt instruments that can be used to obtain finance by borrowing. We have explained short-term debt financing. Now, what are the things we should note here? In addition to what we have explained, debt capital might be irredeemable or redeemable. Debt capital might be irredeemable, permanent debt, or redeemable debt. What is redeemable debt? What is irredeemable debt? Irredeemable debt, these are debts without a specific maturity date. You can also call it permanent debt. The principal amount will not be repaid. Annually, the interest will be paid to the lender, but the principal amount will not be repaid. This kind of finance is not very common. Redeemable debt. Debt with a specific repayment date. Redeemable debt. Debt with a specific maturity date. Nature of debt finance or characteristic of debt finance. You can call it nature of debt finance or the characteristics of debt finance. The term debt finance is used to describe finance with the following characteristic. 1, the borrower receives capital either for a specific period of time or possibly in perpetuity. That means the debt finance could either be redeemable or irredeemable. The borrower will receive capital from debt finance either for a specific period of time or possibly in perpetuity. This is one of the characteristics of debt finance. 2, the borrower acknowledges an obligation to pay interest on the debt for as long as the debt remains outstanding. If a company obtains debt finance, you are agreeing that you will pay, you have an obligation to pay the interest on the debt, in as much as the principal amount has not been repaid. Lastly, the borrower agrees to repay the amount borrowed when the debt matures. At maturity, you agree to pay the principal amount. So please note that debt finance might be secured or unsecured. This is also part of the quality of debt financing. Equity finance is not secured on anything. Equity finance, if you buy company shares, you are providing equity finance for the company. There is no security to equity financing. But debt finance might be secured or unsecured. Secured debts or a debt finance might be secure against the asset of the borrower. In other words, if a company is trying to obtain debt finance, you need to check, do we have sufficient non-current assets that will serve as collateral security for this loan? If a company is trying to obtain debt finance, the company is going to check that, look, to obtain debt finance, the lender is likely to demand for what? Security for this debt. When a debt is secured, the lender has the right to seek repayment of the outstanding debt out of the secured asset or asset. When a debt is secured, the lender has the right to seek repayment of the outstanding debt out of the secure asset. In the event that the borrower fails to make repayments of the interest and the principal repayments on schedule, the lender can go to the secure asset to obtain repayments of the outstanding debt. What this means is that secure asset provide a second source of repayment. If the first source fails, to the lender is now rest assured that if the company fails to repay the money, we can fall back to the company assets to obtain repayment. You can also have unsecured debt. A debt without security. In this case, the lender does not have second source of repayment in the event of default by the borrower. So, when a company is taking debt finance, the company must be aware of the risk involved. Financial risk. The risk that where the borrower fails to pay, the lender can force the company into liquidation. Also, whether the debt is secured or not, the borrower is usually required to give certain undertaking or covenant to the lender. We refer to this as the debt covenant. In most cases, when a company obtains finance by borrowing, this borrowing always comes with conditions. In addition to paying the interest and the principal amounts, the lender can give additional conditions for the loan. And the borrower, once the borrower accepts the loan, then the borrower must comply with the conditions attached. That's a risk. Debt covenant. Some of these conditions may not be favorable to the company. Some of these conditions may not be favorable. For example, the lender might say that one of the conditions for this loan is for the company not to pay dividend to shareholders. I'm giving you a loan, and I'm saying that one of the conditions for this loan is that you must not pay dividend to your shareholders for the next 3 years. That means once you accept the loan, you accept the condition. The lender might also say you cannot obtain loan from another source without repaying our loan first. These are conditions. These conditions can limit the operation of the directors. You can have straight debt. You can have straight debt. Straight debt finance. The term straight debt means a fixed amount of redeemable debt at a fixed rate of interest. A straight debt means a fixed amount of redeemable debt at a fixed rate of interest. For example, 200 million naira loan, 6% bond, maturity 15 years. This is very clear. The amount is clearly stated. The interest clearly stated. Maturity clearly stated. You can also have convertible debt. Convertible debt, we also call it convertible bond, convertible loan stock, convertible debentures. I've explained this before. These are debt instruments that can be converted into a predetermined debt instrument that gives the debt holder the right but not the obligation, because that term is very important. Convertible debts are debt instruments that gives the debt holder the right but not the obligation to convert the debt into a predetermined number of ordinary shares. Once this debt is converted to ordinary shares, the principal amount will not be repaid. Please note, regardless of whether long-term debt, short-term debt, medium-term debt, all debt finance comes with interest payments. All debt finance comes with interest payment. The interest payment may be fixed or floating rate. The next topic after this will be bond valuation. Deliberately, I plan that once I finish this out. Please note, all debt finance comes with interest payments. This interest, please note, the interest may be fixed rates or floating rates. Most of us, we are used to fixed rates. Annually, you pay the interest, 10% annual fixed. But also note, you can have floating rates or variable rate loan, where the interest rate is not fixed annually. The interest rate is based on NIBOR. I will explain more when we get to bond valuation. Hopefully tonight. Any question, please? Any question, please? All right, please, can you please allow me like 2 minutes or 3 minutes? I will join the class. We now look at Islamic finance for like 20 minutes. Please give me like 2 minutes, please.
I'll come in, sir. Islamic finance, Mr. Adejuwa has covered it. So except you want to recap it. We ran through it
Oh,
before.
it has been treated, right?
It's been treated
It has been
completely.
treated, right?
Yes.
Oh, thank you. We move to bond valuation. Is that clear, please? We move to bond valuation. Please just allow me to share the material for bond valuation. Oh, thank you for that. We move to bond valuation. Please allow me just like 5 minutes. Let me look at the material for bond valuation. Let me check.
Sorry, I don't know. I'm new in this class, so I've not. This Islamic finance, I've not been taught, so I don't know
Same
about
here,
that.
sir.
Thank God you are speaking out to. All right, like he said, it's very possible you missed Adejuwa's class, but I'll just do a brief recap to explain it. No problem. It's noted. It's noted. Is that clear, please?
Yes, sir. Thank you.
We'll take it. No problem. Please just allow me like let me see this. I'm trying to take this along. Okay, please give me just 2 minutes. All right, let's go on with the class. Islamic finance. Just as we have the conventional finance that we are used to, we also have Islamic finance. Islamic finance is the finance that draw its existence from the concept of Sharia. Under Islamic finance, it's a finance that is based on adherence to the Islamic law. It offers services, products, instruments in compliance with Islamic law. Just like conventional finance, you can obtain loan under equity, you can obtain loan under debt, and we also have other sources of financing under Islamic finance. But one thing peculiar to Islamic finance is this finance believes that acceptance of interest is completely prohibited when lending or borrowing it is completely prohibited for the lender to accept interest. It is equally prohibited for the borrower to pay interest. This is because under Islamic finance, money is not an asset that can be traded. You cannot sell money and buy money under Islamic finance. Rather, money is a medium of exchange. Money is a medium of exchange, not an asset that you can use to generate interest. In other words, you cannot earn return directly on money by trading your money. By borrowing somebody money, you now collect interest. Now, the question will now be, how does Islamic finance operate? How do Islamic banks make profits? Islamic finance is based primarily on partnership banking. The concept of Islamic finance is based on partnership banking, where the bank and the customer will jointly finance a project. Any profit realized from the project will be shared between the bank and the customer on an agreed basis. And if there's loss resulting from the business, both the bank and the customer will also share the loss. This is the major or the differentiating factor between Islamic finance and conventional banking. Under conventional banking, the bank will give you loan. Whether you succeed or not, the bank will collect the interest and the principal repayment. But under Islamic finance, finance is provided to support the business. However, the bank will not demand interest. The bank will only look at profit sharing. This will be very strange in our environments. This will be strange in our environments. Also, Islamic finance can only be used to finance ethically acceptable business. Ethically acceptable businesses. It is not sufficient for a business to be profitable. That business must also satisfy ethical conditions or criteria. For example, alcoholic business may be profitable, but it is unethical. Alcohol is injurious to human health. Under the concept of Islamic finance, you cannot finance a business that is injurious to the health of human beings. even if that business is profitable. So beyond the interest, that business, beyond being profitable, that business must also satisfy ethical conditions. You cannot do unethical business. You can't run motel or a gambling house. Gambling is injurious to people's health. That is the concept of Islam. The concept of gambling is 100 we pay, 100 we go and bet, 1 or 2 we win. Technically, what is the gambling company rendering? What is that they are rendering us? What service or services do gambling company render? What value do they create in the system? But we are in a circular world where everybody has a choice to make. All right, let me round up. Islamic finance package. You have musharaka. What is musharaka? Just as we have, okay, we have overdraft, we have debentures, you have loan stock. Same applies to Islamic finance. We have what we call musharaka Islamic finance products. This is a finance product, and it involves profit and loss sharing partnership. Musharaka is a profit and loss sharing partnership, and it is the most authentic form of Islamic financing. It's a contract of joint partnership where 2 or more partners contribute capital to finance a project or to own a real estate. Under Islamic finance, there must be a project, physical project we are financing, a real estate or movable assets. The bank is also part of the partner in financing. The company and the banks come together to finance a project. The bank will contribute finance. The company also contributes finance. The bank can also take part in the management of the project. Where profit is achieved, profits are distributed according to pre-agreed ratio. Where a profit is achieved under Musharaka Islamic finance, the bank, being a partner, will share in the profits. The company, also being a partner, will share in the profits according to pre-agreed ratios. However, where losses are incurred, this will be shared between the partners, that is between the bank and the customer, in accordance to the capital contribution. In this case, there is no concept of interest. So even in Nigeria, we have Islamic Bank, we have Jais, we have Lotus Bank, we have Tajid. The number is growing. And interestingly, the customer base has nothing to do with your religion. You can walk to that bank and open your account. And if you satisfy the condition, you can obtain loan under Islamic finance. That's number one. Number two, we have Mudaraba. Mudaraba Islamic finance products. This is a profit sharing and loss bearing contract. Mudaraba Islamic finance package is a profit sharing and loss bearing contract whereby one party supplies the funding, the finance required. The other party provides effort and management expertise. Mudaraba Islamic finance product is a means of financing that involves profit sharing and loss bearing contracts, whereby one party, that is, whereby bank will supply the finance required for the business. Bank will supply 100% finance required for the business. The company will provide effort and management expertise. The company will manage the profit. The company will manage the business with a view to generating profits. Where a profit is achieved, both the bank, the provider of finance, and the company will share the profits mutually as agreed. Where a profit is realized from the business, both the bank is the provider of finance, and the company manages the business. We share the profits on the basis of pre-agreed ratio. However, in the event of loss, only the capital provider will bear all the entire loss. If the bank has provided finance, only bank will bear the entire loss. If you look at this very well, this is like equity financing. Under equity finance, the shareholder provides finance to run the business. The company's management manages the business. Where profit is achieved, the company's management will take part of the profits. They will distribute dividend to shareholder. Profit distributed to shareholder, dividends. But where the business incur losses, the director will not pay anything. It is the shareholders that will suffer the loss. Mudaraba is just like equity financing. The bank can provide the equity finance for the business. And if there's profit, the bank will benefit. If there's loss, the bank will bear the entire loss. You know, it sounds funny. The question is, why would the company not bear any loss? It is believed that The management has provided management expertise and effort. The manager bear no financial loss because the manager has lost his time and energy invested in the business. That time you spend going to work every day is money. You are making effort for the business to survive. You are having sleepless nights. But unfortunately, there's a problem. The business incurs losses. So it is assumed that the management has invested their time, their energy, their competence into the business. So they should not suffer any financial loss. This is the concept of Mudaraba Islamic finance. Number 3, we have Murabaha. Murabaha is simply trade, it's just similar to trade finance. Murabaha is a popular Sharia compliant sales transaction, mostly used in trade financing. Under this contract, the bank purchases the goods and delivers them to the customer, deferring payments to agreed dates by the two parties. Under Murabaha Islamic finance is similar to trade financing. For example, we run a bakery business and we require raw material on a daily basis, and we don't have that cash to buy the raw material. We can go into Murabaha Islamic finance. Bank will purchase the raw material for us. Bank will pay the producer, deliver the raw materials to the customer. The customer will use the raw material to continue with his own, to produce his own products. At a later date, the customer will repay the bank at agreed future dates. Now the question will be, how would the bank benefit? First is banking. The initial concept of banking is supposed to be a pivotal of development. Banking is not originally designed to be making excessive profits. Banking is supposed to finance industry development or industrial development. Now, if the bank is able to provide raw material for this manufacturer, for this bakery now, you can run your business, employ more people, and pay back at a later date. The economy is growing. Production is expanding. The manufacturer of the flour is also making sales. The economy is growing. During repayment period, it is expected that the customer in this case, the bakery owner will present a sincere account of the profit achieved. You know, in Nigeria, lying is normal. In fact, if you are not lying, you will be seen as an outcast. Lying is normal in Nigeria. What is abnormal is to be saying the truth. Under the concept of Islamic finance, it is assumed that nobody will lie. So if you bake your bread, you run your business, you are going to present account of the actual sales made, actual profits made. Then the company can now take certain percentage of your profits, collect your repayment, still continue to finance your business. And where you incur losses, it is believed that you are not lying. You must have taken all necessary effort to achieve profits. And eventually you incur loss. The bank will not ask you to go and look for repayment because it's not a loan. Bank will not be forcing you. Go and look for repayments. The bank will take risks for the economy to grow. Then I have Ijaro and Sukuk. Ijaro is basically leasing. Once you understand the concept of lease, then that is Ijaro. Under Islamic finance, it is called Ijaro. It's a contract of sale of the right to use an asset for a period. Ijaro is a contract of sale of the right to use an asset for a period of time. It is essentially a lease contract where the lessor must own the asset for the entire lease period. Ownership remains with the lessor, the owner of the asset. A company can obtain finance under Ijaro by leasing an asset, and the company will pay lease renter, just like the conventional leasing. But under Islamic finance, there is nothing like movement of ownership. Ownership stays with the owner. The lessor is also responsible for maintaining the asset. So you pay annual lease renter. Then lastly, we have Sukuk fund. I think this is common in Nigeria, Sukuk fund. Sukuk is the Islamic equivalent of bond. Sukuk are long-term debt finance. And please note, this finance is asset backup. Under Islamic finance, there must be an asset you are trying to achieve. Unlike the conventional bond is a promise to repay loan. Sukuk constitutes partial ownership. Let me explain that. When you are talking of Sukuk finance, the company or a nation or a state want to finance construction of road. This road is for the society generally. Now, governments can decide to issue sukuk bond. Under this bond, investor will subscribe, but it's an invitation to ownership in assets. What I mean is the amount will not be repaid. Interest will not be paid. When the funds is generated, it will be used for the project, assuming road construction. When the project is completed, individuals that have invested in the sukuk bond become the owner of that asset, partial ownership. Individuals that has contributed to that bond become the owner of the asset. Now, if income is generated, like we have road construction, you now have a toll gate where we collect toll on a daily basis. From this toll collection, certain amount will be set aside for road maintenance. For the road maintenance, then the balance will be distributed to the owners, people that have invested in the sukuk bond. In as much as that property is existing and is generating income, certain amount will be distributed to the owner who have invested in the bond, the sukuk bond. But there is no repayment of the principal amount. All this we have under Islamic finance. Any question, please? Any question, please? On this note, we shall be dropping on finance success. Then we move no doubt we have been spending hours, but we still have like 45 minutes. I'm sure we can still do something reasonable with this 45 minutes, because time is of importance for this transaction. Maybe we can take 2 minutes. This is 10:15, and we are all human beings. Maybe we can take like 2 minutes. I will now introduce this for like 20 minutes. Let me discuss this concept. And we now start calculation in our next class. So please, We can take like 2 minutes. Bond valuation. Please, as much as possible, let us note some points down here. A bond is a debt instrument requiring the issuer, the borrower, the issuer is the borrower. A bond is a debt instrument that requires the issuer, in brackets, the borrower, to repay the lender the amount borrowed and the amount borrowed plus the interest over specified period of time. A bond is a debt instrument that requires the borrower to repay the lender or the holder the amounts borrowed plus the interest over a specified period of time. Let us expand that. A bond is a legal instrument that authorizes or that establishes relationship between borrower and lender. A bond is a legal instrument that establishes relationship between the borrower and the lender. These instruments authorize the borrower to repay the amount borrowed plus the interest elements to the lender over specified period. From this explanation, we have two parties to bond. From this explanation, there are two parties to bond. One is the borrower. Two is the lender. From the perspective of the borrower, a bond is a liability, and the interest payable is an expense. Let's listen to this. From the perspective of the borrower, a bond is a liability, and the interest payable on the bond is an expense. From the perspective of the lender, a bond is an asset. Receivable is an income. You have to be very careful. If you are required to define bond, you need to tell the examiner, do you want to define from the perspective of the borrower or from the perspective of the lender? If you are coming from the angle of the lender, a bond is an instrument an asset that is used to create investment with an expectation to get returns. For example, if a company issues bond, that company is the borrower. If the investor invests in this bond, the investors are the lender. To the investor, that bond is an asset. The borrower will pay interest. The lender will receive the interest. So please, let's be mindful of these. All right? Characteristic of bond. 1, the face value. The face value, this is the amount stated on the face of a bond instrument. The face value is the amount written on the face of a bond instrument. Please note, the face value could either be 100 naira or 1,000 naira. Please note, the face value could either be 100 naira or 1,000 naira. Like if you pick your 100 naira note, the amount written on the face is 100 naira. That is called the face value of the instrument. You can also call it the nominal value of the instrument. Anywhere in the world, face value of a bond is either 100 or 1,000 naira. And please note, where the examiner is silent about the face value, you can either assume 100 naira or 1,000 naira. Next, the coupon rates. Coupon rates is the annual interest rate stated on the face of the bond. These coupon rates will either be fixed coupon rates or floating coupon rates. These coupon rates could either be fixed coupon rates or floating coupon rates. For fixed coupon rates, that means the interest rate stated on the face is fixed. The amount is fixed, 10% annual interest rate throughout the maturity of the bond. Alternatively, you can have a floating rate bond. This is bond with interest rate that fluctuates with changes in the general level of interest rate. Floating coupon rate bond, the interest rate will always change. The interest rate is changing. For example, examiner can say this bond is issued at a rate of 2% plus NIBOR. NIBOR rate is the Nigerian interbank offer rate. The loan is obtained at 2% plus the NIBOR rate, Nigerian Interbank Offer Rate. This rate is not static. It's always changing. We also have LIBOR rate, London Interbank Offer Rates. So you can have a bond running on the floating rate. We also have zero coupon rates, zero coupon bond. These are bonds that pay no interest. These are bonds that pay no interest during their entire life. These bonds generally mature at face value, but are issued at a large discount to the face value. Zero coupon bond, debt instruments that will not pay any interest. No interest on this debt. This debt instrument will mature at the face value, but the issue price is at a discount. The return on such bond is known as capital appreciation, which is the difference between the issue price and the face value at maturity. Let me explain that briefly. A company can issue a bond at 70 naira. Remember, the face value is 100 naira. You now issue the bond at 70 naira. When the bond mature, the bond will mature at 100 naira. That means if I'm buying the bond, I will pay 70 naira issue price. At maturity, you are going to return to me 100 naira. My return is difference between the issue price and the face value, 30 naira per bond. That is the capital gain. Interest will not be paid annually. That is zero coupon bond. But this bond is not very common. Lastly, you can have premium bond, discount bond, or par bond. Premium bond. If the market value of a bond is greater than its face value, where the market value of a bond is greater than its face value, such bond is called premium bond. For example, if the market price of a bond is 120, and we know the face value to be 100, then that means that bond is a premium bond. Discount bond, bond having the market value less than its face value. For example, if the market price of a bond is 70 naira and the face value is always 100 naira, that means that bond is issued at a discount. Lastly, par bond. Par bond, where the market value of a bond is equal to the face value of the bond. In that case, you have a par bond. Please note, a bond may be issued at a premium, or at a discount, or at par. Please note, a bond may be issued at a premium or at a discount or at par. Also note, a bond may be redeemed at a premium or at discount or at par value. How do we value bond? How do we calculate value of a bond? How you value bond will depend on the type of bond you are dealing with. Please note, please type this down somewhere. How you value a bond will depend on the type of the bond you are dealing with. Remember, you can have redeemable bond, you can have irredeemable bond, or you can have convertible bond. Recall our discussion on debt finance. You can have redeemable bond, irredeemable bond, convertible bond. So how do we value this bond? The price of any asset is equal to the present value of the expected cash flow from the asset. In other words, if you are to value redeemable bond, redeemable bond is the value of redeemable bond is calculated as the present value of expected cash flow from the bond. Value of a redeemable bond with a fixed coupon rate is calculated as the present value of the expected future cash flows associated with the bond. What are the cash flow associated with redeemable bond? 1.
Interest.
Annual coupon. Annual coupon interest from year 1 to maturity. 2. Redemption value of the bond at maturity. What are the cash flows associated with redeemable bond? The first one is the annual coupon interest from year 1 to maturity. The second one is redemption value of the bond at maturity. Remember, a bond can be redeemed at par or at a premium or at a discount. Please remember, a bond can be redeemed at par or at a discount or at a premium. Where the examiner is silent about the redemption value, please note, where the examiner is silent about the redemption value, you are going to assume par value. Now, these cash flows are discounted using the bond yield. This cash flow will be discounted using the bond yield. Zero coupon bond. How do we value zero coupon bond? The price of zero coupon bond is calculated as the face value divided by 1 plus y raised to power n. Where your P is the price of the bond, value of the bond. The F is the face value. And Y is yield to maturity. The small letter n is maturity of the bond. We have explained valuation of redeemable bond. Let us look at how do we value irredeemable bond. Bond without a specific maturity date. Is calculated simply as the interest divided by the bond yield. In most cases, examiner will hardly test valuation of redeemable bond because it's direct. Just pick the annual interest, divide it by the yield. You know, it's like saying you want to calculate the present value of a cash flow to perpetuity. If you want to value redeemable bond, the interest will be paid to perpetuity. Principal amount will not be repaid. So we simply calculate present value of interest cash flow to perpetuity. Interest in year one to perpetuity. Then we have convertible bond. What is convertible bond? We have explained it. Debt instruments that give the debt holder the right, but not the obligation, to convert the debt to equity. This conversion option is within a specified period. Now, how do we value convertible bonds? Please note, there are two ways, or there are two alternatives when you are required to value convertible bond. Convertible bond can be valued as a straight debt, or you can determine the conversion value. The first alternative is to value the convertible bond as a straight debt. This valuation assumes that the convertible bond will not be converted to ordinary shares. Hence, we are going to value as a debt, straight debt, a debt that will not be converted to ordinary shares. In this case, you are going to determine cash flows associated with the convertible bond, and these cash flows will be discounted. These cash flows will be discounted with the required return on ordinary debt of the same risk class. Please, this was deliberately underlined. When valued as a straight debt, you are going to determine the annual interest from year 1 to maturity, redemption value of the bond at maturity. These cash flows will be discounted to their present value using required return on ordinary debt of the same risk class. Examiner will always give you this figure. Alternative valuation. We can calculate the conversion value. This alternative assumes that the debt, the convertible debt, will be converted to ordinary shares. And we can calculate value of the ordinary shares. So you can either value as a debt or as an equity. The conversion value can be calculated with this formula. Conversion value in year N is equal to PO bracket open 1 plus G bracket close raised to power N multiplied by R, where your P is the current share price. The G, annual growth rate in share price. N, number of years the holder can exercise the right of conversion. And your R, conversion ratio. Your conversion ratio is number of ordinary shares a bond will be converted to. You can use this to derive the conversion value. Our next discussion, bond yield. The yield measures. The yield is the return on bond. The yield. This is the return on bond investments. There are three types of bond yield. There are three types of bond yield. One, you have the nominal yield. Nominal yield is the coupon interest. That is the nominal interest on the bond. The coupon rate on the bond. That is the interest rate, the actual interest rate stated on the bond. That is the nominal yield. Then you have the current yield. The current yield relates the annual coupon interest to the market value of the bond. The current yield relates the annual coupon interest to the market price of the bond. It is expressed as your current yield is equal to annual coupon interest divided by the market price of the bond. The current yield is used to measure the current cash flow on bond investments. This is useful to income-oriented investors, investors that are interested in annual income. The current yield shows annual return on bond investments. This yield is of limited use. The current yield is of limited use because it does not consider the capital gain or loss that the bondholder will realize if the bond is purchased at a discount or premium. It does not consider the capital gain or loss that the bondholder will realize if the bond is purchased at a discount or at a premium. Also, it ignores the time value of money. The current yield ignores the time value of money. Then number three, the yield to maturity. Yield to maturity is the most widely used bond yield measure. The YTM, that is the yield to maturity, considers the interest income, capital gain or loss, and the time value of money. Yield to maturity is to bond what internal rate of return is to capital projects. Yield to maturity is to bond what internal rate of return is to capital projects. What is internal rate of return? Look at that statement. Yield to maturity is to bond what internal rate of return is to capital projects. The yield to maturity is calculated as the internal rate of return of the cash flows associated with a bond. I'll round up here now. Usually we compute yield to maturity by calculating the internal rate of return of the cash flows associated with the bond. You can also use formula approach. Assumptions of yield to maturity. 1. All coupons can be reinvested as the YTN. One of the assumptions of YTM is that the coupon interest rates can be reinvested at the YTM. Number 2, the bond is hedged. It assumes that the bond is hedged to maturity. Three, all coupons are received in prompt and timely fashion. It assumes that all the coupons are received in prompt and timely manner. This was tested May 9th. Examiner says, explain why a company may not realize the yield to maturity. Look how the examiner did. He didn't say tell us the assumption of yield to maturity. He said, explain why a company may not realize the yield to maturity. The part A of the question says, calculate yield to maturity. The part B now says, explain why the company may not realize the yield to maturity. One is that if the coupon is not reinvested at the YTM, then there will be a problem. If the bond is not held to maturity, there will be a problem. If the bond is not held to maturity, that means you cannot realize the yield to maturity. If coupon interest is not reinvested at the yield to maturity rate. That means you cannot realize yield to maturity. All coupons are received promptly and in timely fashion. If coupons are not received as at when due, when we say coupon, if the interest rate is not received as and when due, then you will not be able to earn the yield to maturity. Instead of asking that, what are the assumptions of YTN? Examiners say, why would the investor not realize the yield to maturity? All right, I'll stop here. We have done reasonably. I'll stop here. Our next class, please, let's try to look at the video so that we can prepare against next class. Next class, we'll be able to take questions. We start from bond duration. All right.
Sir, please, I
Any
have a question.
Please go ahead.
Sir, please, I don't know if we can get solutions for other questions, because the last class you taught us, we had one question we didn't solve. And there is no way. The BJ PLC, the last question, the E part, we did not solve it.
Oh, the E part?
Yes, sir. You said in the next class, but I'm sure you forgot.
Okay, I didn't even say next class. I didn't even say assignment self. I gave assignments separately, which you did. Nobody has even submitted anyway. I only said that question, that E part was not part of the question. I personally imported that part to it. But I would have loved to solve it really. But it was just the time that I was battling with. Okay. I'll try and make solution available.
Thank you, sir.
All right. Any other question or observation on this note? We shall be leaving the class.
Hello, sir.
Yes, please.
This right issue. You did those 4 absorption, whether it will take up the rights, it will buy and take the right and buy. You didn't solve any question regarding to that. I don't know.
That was what he said now. In fact, that was the intent of putting that part there, is to actually explain that aspect. Okay. There's a question involving, okay, there's a question on your study pack. It involves right issue and bond valuation. There's a question on your study pack. That question, it involves right issue and bond valuation. Now, because I have not treated bond, there's no way I can bring that question in. I will find a way to structure that question to cover that aspect you mentioned. It's noted, no problem. All right, it's noted. I'll find a way around it. All right, if there's no question or observation again, we shall be calling it a good night.